he volunteered to do a little coaching session. Oh, all right. Hey, Simple Passive Cashflow listeners. Today we have Fortnite champion Jason here. No, he's just borrowing his kid's headset.
That's right.
Get a sense of, maybe apply themselves to one of these situations. I think today's going to be, you're kind of right in the middle there, Jason. You're not a broke guy that I talk to who's just, been working for 5 years or less. And you're not one of these guys with $1 million or $2 million or like 35 grand coming in every month. We just had one of those guys. You're just like, you're sort of like me, actually, just kind of a grinder right in the middle. But how about we start off with the top? Maybe just tell us a little bit about yourself, where you're from, and then how you kind of got started in investing. Because you've got a few properties, so you're not a newbie here.
Yeah. So I'm Jason Painter. I'm from Chattanooga, Tennessee. Born and bred here. I currently work at the nuclear plant that's close to this area, which gives me a pretty decent income for this part of the world. I'm, I'll say like I'm making about $120,000 from that job, which again is a great salary for this part of the world, and it's been able to help give me some extra income to be able to put into the passive income that I've been trying to get. What's gotten me down the passive income is, it's just the typical grind of the W-2 job, some of the uncertainties that come with the W-2 job, some of the lack of the control, I guess, that you have over your W-2 job has what's led me into passive income. And a good way.
So how is how's the job these days, and has it kind of improved over the last 5-10 years in terms of difficulty and just the energy that it takes?
So the job that I currently have at the nuclear plant, I'm in nuclear operations, and that's just exactly how it said. We are in charge of operating the plant, and my schedule is a swing shift schedule. So that's kind of a big drawback about the job. That's one of them. Secondly, there's not really a lot of room for growth. I've tried to find other jobs within the plant, and we get kind of short staffed, and we have to meet a certain number of people to fill the shift. And so when it comes down to it, they're not really willing to let people out of operations. So in a way, it's pretty much a dead end job. I mean, if I don't stay on the path of nuclear operator, then there's really not any options beyond that. So
Right. And I think a lot of people have this this kind of predicament. You get into kind of a niche occupation. It's not like you can go and do something else in another industry. You're kind of pigeonholed in that job and role.
That is exactly right. There are about 100 units across the nation, nuclear units, and there are 2 others close to this area, within a few hours driving distance, but it would require relocating. And, I don't want to relocate. The job that I have now was something that I sort of fell into through a network. I'm not an engineer by trade. I was not in the Navy. I actually have a degree in ornamental horticulture. My parents have a retail nursery here in town, and that was kind of my background. And through landscaping, actually, I was landscaping for this guy who had a job there at the nuclear plant, and he's the one that got me on there. So that's how I ended up there. And like you said, I mean, it's a total niche job, that's for sure.
Oh, cool. So you own a few rentals now. How long ago did you start, and what was your first steps?
Yeah, so I started back in 2016. My first steps were just starting to absorb all the information I could. I actually, one of the first things I really started getting into were the podcasts, namely the Bigger Pockets podcast. And then from there, I just kind of started branching out. You know, one podcast begat another one. And so it was a lot of education is what I'm getting at first. You know, just kind of gathering information. And then at the first of 2017, we bought another home, and we kept our original primary residence and turned that into the rental. That was the first rental we had. And by we, I mean my wife and I. Um, and then last year, I got two more properties to add to the portfolio.
So when you started this, how much liquidity, where did the down payments come for these properties? Were you just kind of sitting on cash from the
Yeah,
get-go?
no, I didn't. I really was never at a point where I had a whole lot of cash. What I did have was a lot of equity in our last house, and I used a home equity loan from that house. The you know the way the real estate market has gone here as of late, you're either going to sell it for really high, or the house that you own is going to appraise for probably way more than what you have into it, most likely, especially if you own it for any amount of time. The last residence we had, I bought back in 2005. So by the time we moved out in 2017, there was a ton of equity in it. So anyway, we borrowed or I got a home equity loan started against that, and that's what I've been using to fund the down payments for these houses.
Do you recall how much was the max capacity you could take out?
The max of the home equity loan?
Yeah.
Yeah, it's 82.5, I think, is the
Okay.
total available.
And that was like 80% loan to value.
Yeah. Well, it's so the process there is just like if you get a mortgage on a primary residence, you'll get traditional mortgages 80% loan to value. The same kind of applies with the home equity loan. You get 80% of the equity in that case. So, I guess there was 100,000 of equity is what the appraisal came back. I guess around 100. Well, it came back at 165, and then I forget how they got to 82. It's roughly 80% of the equity.
Yeah, I think
Is
I think what they
what
do
a
is
home
like
equity.
they take your appraisal and then they take 80% of that, and then they subtract your current mortgage amount, how much you owe, and then that's how they come out that
Yeah.
82,000.
Mhm.
So, I mean, and I guess you can talk about if you went into kind of the turnkeys after that. But that's sort of enough to buy maybe 2, 3 houses. So what was your
Yeah.
your kind of next steps, and how did you kind of come to that next buy?
Well, I still had money available. So at this point, that home equity loan is maxed out because I bought two houses with that. Now, the criteria I've been following for the last two rentals that I bought, and really this fell in with the same with the first rental that we had, which was our former primary residence. Um, they're both houses, or all three are houses that were around 150 for acquisition, and they rent for about 1,500 in this area. So the 1% rent to value sort of falls into play there, which with the other two houses lends itself to about a $30,000 down payment, and then there was some rehab involved. Um, well, about 3,000 in the first one of last year, and then about I think roughly 9,000 with the one at the end of last year. So by the time I've gone through the down payment and the rehabs, that's what's maxed it all out.
Right. And both of those deals were local in Chattanooga.
Yeah, I've been sticking strictly to being a local investor. I do from time to time try to find things outside of this area, but as of now, everything's local.
Yeah. And that's usually the, when I have calls with folks, it's kind of, I get a sense of where you're at. And I don't know Chattanooga too well, but I know enough that to know it's a lot better chance of finding something that cash flows than California. I mean, if you're in California, Washington, Portland, Hawaii, you don't got a shot. Just you got to go out of state, get a turnkey. But this is one of the things is your advantage here.
Yeah, and actually, there are a lot of out-of-state investors, from bigger markets that come into this area. I mean, so Chattanooga is, if you look at the county as a whole, which is called Hamilton County, there's about, I think, 350,000 people. And to find a house that's around $150,000 is just your typical 3-bedroom, 2-bath. Um, it's Chattanooga is, probably the average income is the $40,000 to $50,000 range. That buys you a pretty decent life around here. So
Yeah. So I see your properties, and you mentioned the total value is like around 120 or so, and I'm just looking at some of the rents here, 1,100, 1,500. So you're kind of staying in some of the better parts, right? Like maybe B plus, A minus type. Good.
yeah, they. I mean, I've always considered them more of a B class, but to be honest with you, there's probably a lot of them that push an A class.
Yeah.
The first our first home that we turned into a rental, the one that was renting at 1,100, it's in a part of town that's in a really, really hot market right now. The homes in that area were built in the 40s, and it's kind of this. It's like a trendier area with those older sort of craftsman style homes. People are looking for that kind of home. And then, as a side note on this one right here, this one we rent to my in-laws, and so it would rent for a lot more, but they're kind of getting a sweetheart deal, and I'm getting a lot of maintenance free issue, or not having a whole lot of maintenance issues, that comes with that 1,100. If we were renting to someone else, that would be an easy $1,500 a month house, if not maybe even 16 or 17, just because of the area.
Right.
And the other two,
I don't want to out you on a recording here, but if it is a family, maybe a good idea would be to just take the money under the table and then not write any of the deductions off. But that's a good idea if you're going to sell it pretty quickly. But
yeah, right. And I understand your point there. What I've really tried to do on this stuff is keep everything out there. So, hopefully like down the road, it helps build credit. I can use it to be more bankable, that kind of thing. So, and
right.
plus on this house right here, on this East Daytona house, there are a lot of tax deductions or depreciation that we have never taken on the house. And so, we're getting some of the benefits off of that as well. Because our tax liability just off of our W-2 is pretty high.
Well, so I'll kind of go over the overview here. This is the personal financial sheet summary, and just to get a sense of where you're at. I mean, look, your assets here are mostly because you've got the properties, which is kind of negated by the mortgages you have, which is a good thing, in my opinion. I mean, you're effectively leveraged, right? It's not like you've got dead cash or lazy equity.
Right.
you're a little thin on cash at hand. I mean, you're probably in the mode to go buy that next one, which makes total sense, right? I mean,
Oh yeah.
that's the grinder mentality at this point, right? You just got to save up for more down payment money for the next one.
Mm-hmm.
Um, that's your guys' financial sources of cash, and then I'm just kind of just spot checking living inspection and expenses, and how much money you guys able to save at the end of the year as you figure. That's kind of the main thing I usually.
Well, so
I mean, you're
you
gonna
know,
go on a vacation, you're gonna buy a couple nice things, but at the end of the year, how much are you pretty confident you can kind of sock away?
well, the real number that we're socking away is what we end up with in the 401k at the end of the year, and that is it's like 15,000, I think, is what we end up putting away in that. I'm actually looking at doing a whole life insurance policy, which I'm getting pretty close to getting set up. And then as of now, I'm looking at putting 10,000 a year into that. So
Okay,
all
like
told, and that
infinite
will be
banking.
right.
So, I mean, my idea here is the the Fidelity account, the 401k. I think you got to cut that off and possibly cut off the whole life, so you can keep getting the cash on hand to be investing it in cash flowing deals, because I suspect that you're getting a higher return on that than the retirement account and the whole life. And
I
that's the
mean,
problem. That's the problem with the whole life, right? I mean, that's what I did. I put away, 50 grand my first year, and 30% of it goes away in year one to fees. That's like
mm-hmm.
half, that's $15,000. That's like half of a turnkey rental, right? That's,
Yeah.
if a turnkey rental is getting you 200 to 300 a month, that's like 150 a month that I'm not getting because I socked it away in a whole life. It's infinite banking is great, but it's more for guys who have a substantial amount of net worth that they needed that extra place of store cash in interim.
Yeah, that's kind of the conundrum I'm at. So with
Yeah.
this,
So let's talk about this. I mean,
yeah, because I am kind of coming to a crossroads. So this is a great discussion for me to have. So for one, with the Fidelity account, one of my concerns there of backing away from that is if I don't put the 800 a month roughly, or it's like 830 a month. Let's see, is that right? Yeah, 830 a month that I put in. If I don't do that, then I don't get the company match. Okay, and
what
I
is
guess
that, like
that's
three
part of the golden
three
handcuff.
percent or 6%? What is the
No, the 6%. Yeah,
6%? And then they'll
yeah.
they'll do it dollar for dollar or 50 cents a dollar or something like that.
I think it's dollar for dollar.
Okay.
It's dollar for dollar. So that's the thing. I put in 833. They put in 833. So if I start backing off of that, then a lot of that goes away.
So
Um,
I will I'll give you that. Do the 6%, get the quote unquote free money.
Yeah, and
Um,
I mean, I hate it, but it's hard. It just the facts of it. It seems to
yeah.
point in that direction.
But I mean, that's only 6%. Are you going to put any more than that, or is that
No, I'm just saying at the minimum. At the minimum
okay?
match.
Okay.
Yeah, I mean, I can put in way more than that, but I don't want to. And it's not so much that. So the biggest problem I have with the 401k, and I'm probably preaching to the choir here, but you know, in studying over the 401k in the past year or two, which I've kind of been more aware. Before I put the money in there and just forgot about it, right? Now I've gotten a little bit more cognizant of what's going on and how it works and those kinds of things. But I've come to realize, I mean, the way that the thing has grown has been from the money that that me and my employer has put in there, you know, a lot of it is not based on the returns, you know, from the market. And, you know, you look at it some years or some days, of course, and it's like 40% return. But, you know, if you looked at it back in 08, 10, you know, those time frames, you know, it's
Yeah.
like -20, -40. So, but I mean, that's a big angst I have about that is the value comes from the money I put in there. It's not the return.
Yeah.
But another angst I have about that is that money is locked away. I can't do anything with it. I can get a personal loan up to 50,000 for it or out of it, but when you pay yourself back, it's like if I did the $50,000, it's like 800 something dollars a month that I would have to pay back. So if I were to say, you know, borrow the money to use for a down payment, the payback on that would be so expensive. It makes it prohibitive to use it to acquire some kind of passive uh, income.
Right. Right. I think you kind of hit it on the head. Like you have to wait to get at that money in the future.
Yeah, I mean, 59 and a half, and I'm 41, so
It's
you
a
know,
long time away, right?
that's the way definitely I feel about it.
So I mean the
So
other point is, you know, the 401k, you're, you know, it's not really tax sheltered. You're gonna pay taxes on it now or later, right? I personally would rather pay taxes now because I'm poorer now. I'm in a lower tax bracket because I project in the future I'll be in a much higher one. And irregardless of that, the government has to pay back all this quantitative easing. So they've got to inflate the money supply to pay off the debt. So it only makes sense that overall taxes will be going up, and that's been the trend. I'm a little bit nicer than you in terms of, you know, I give the 401k a little bit more benefit of the doubt. I still think in the back of my head it's good for about 8% on a long time horizon. But you know, when you're investing in real estate, like how you've kind of proven it already, I mean, you're making like 15, 20, 25, even 30%. I mean,
well, are you talking about on the real estate?
yeah, in the real estate.
Like if you add in the taxes and inflation and things like that, you mean?
Yeah, and the mortgage pay down that your tenant pays you.
Yeah, yeah, yeah. No, I agree with that for sure. So, and you know, back to the 401k, I mean, I agree with you there. It's kind of like I'm sort of stuck with it, I guess. You
Yeah,
know.
yeah. I mean, you're doing the right thing now. I mean, you're just putting the minimum. I mean, what's in the past is in the past. You
Hmm.
know.
Yeah. And so that kind of leads me to this crossroads with this whole life insurance because there, you know, so right now I'm showing 4,000 on this life insurance on the sheet here, and some of that is from the deposits that I've taken off the rental houses. So I'm thinking, hey, that money's just sitting there. You know, why not get something out of it? That's one of my angles with the whole life insurance. Another really big thing is it's a kind of a retirement savings vehicle, but at the same time, you know, it's something that I can get money out of later on as the cash value builds. So you know that's something that's really intriguing
Yeah.
about, you know, trying to use it.
The cash value will build, but it will pale in comparison to the value of your real estate holdings if you would have took that money and put it in that. And I think these life insurance guys, they're all really like kooky on how they give you all these fancy spreadsheets, but nobody gives you the opportunity costs if you would have put it in real estate instead.
Yeah, right.
I think
And
that
I mean, honest.
I think that when the situation comes in when you start using the whole life is like once you've had about, you know, 5, 6 houses and you're kind of just, you're able to save that $30,000 for the next house pretty frequently, like, you know, a couple times a year. And this will help you smooth out your liquidity curve.
Yeah. Yeah. And, you know, I guess really the big thing about the whole life is kind of what you alluded to when we first started talking about it. Like, um, you know, it does make more sense when you have a lot of cash sitting around, you know, not really doing anything. I don't, you know, $4,000 is not really a lot of cash. Like,
Yeah.
that's something I could either apply to pay down these home equity loans or pay down some of these credit cards that I have, that kind of thing.
Yeah. And you know, don't, oh, if something happens to you, I hope so nobody comes and finds me and says, dang it, man, I told you not to get that life insurance. But this is not, we're not talking about life insurance. We're just calling it life insurance for so we don't get taxed on it. The purpose of this thing is not for the death payout. It's the
Right.
shelter money.
And as a side note, I have a short-term policy. So you know, I don't need life insurance. I'm insured by the short-term policy that I carry through work, which
Right.
actually is really, really affordable. I think the whole thing you know, for it's like a $500,000 death benefit. I'm talking about the short term now.
Yeah, the term life one.
Or term life, yes, that's right. It's about a 500,000 payoff death benefit. It also gives me 25,000 for my wife and 25,000 for my kid, and that cost me a whopping like $13 a month. Which, I mean, the little bit I've shopped that around, I think is really cheap.
Yeah.
So I have life insurance. I don't need this for a death benefit. That's for sure.
Yeah. Another concept I'm learning about that you might want to do more reading on as well. There's this thing called like a jailbreak 401k.
Okay.
You know, it doesn't sound like you're gonna move from your job, right? So there's no chance of you getting at that. But once you do move, give me a call up. We'll set up a QRP for you. But in some states, normally red states, there's this thing called a jailbreak, and supposedly you can assign it to somebody else, and in this case you, to get it out. It's kind of this quirky thing where like in, you know, everybody was getting divorces in these red states, and then, you know, in the settlement they had to split apart the 401k, so they were splitting it to their ex-wife. And
Okay.
but you're just kind of going off of that legal loophole and assigning it to yourself.
Yeah.
Regardless of a divorce. So I don't know how it works. There's guys who do it, but I don't know. I mean, just if you're kind of just looking for options, because this is the hard part as a grinder here, you don't really have too many options, right? You got to wait till you save money, and that takes several months. So something maybe just to look into.
Well, and I'll tell you too. I mean, you know, if you look at the balance of this 401k being at $287,000, I mean, that's just such a glaring number. When, you know, I'm dying for cash to get these houses, and I'm sitting there thinking, man, that $287,000 would go a long way, you know. And I've even run the numbers on what if I were to take the penalty and go ahead and just pay the taxes, even the tax bracket that I'm in now. I forget. I think it comes out to about $170,000 is what would be left. And even then, I think, man, I could do a lot with that.
So let's talk about that, because I actually do talk to a lot of people who have like $300,000, $400,000, $500,000 in their 401k, and they read that little purple book, and for them it makes sense to take this money out strategically. You know, don't be a bonehead and take it all out in 1 year. Then your AGI is going to go up, and you're going to be in the 50th percentile on taxes. You know, take out. I mean, how quickly can you buy houses, right? Like 2 a year. I mean, that's a lot, right? So take out 60 grand every year or something like that, or 50. So you stay under that highest tax bracket threshold. I'll tell you, you know, once you're not in this category, but what these other guys are doing, that they're taking like 100, 200 out at 1 year, they're using like not life settlements, but land conservation easements or oil and gas investments to mitigate that AGI. But if they're really smart and they're in the syndications, they can, I was talking to Tom Wheelwright the other day, and he said, if you invest 100 grand in a deal, because of the bonus depreciation, he's seeing people getting $150,000 of depreciation just that first year.
Damn, really? Wow, that'd
So,
be huge.
that's why I like the syndications, right? Because you can do
Yeah,
cost seg and all this magical stuff. Of course, that's just kicking the tax can down the floor. That's just deferment, right?
yeah. Well, but I mean, there's a way that you could keep that deferment going into perpetuity, though, right?
Go on to the next deal, right? You have to be a drug addict.
Yeah,
You got to keep.
right. I mean, and no, the little bit that I understand about taxes, which is very little, but it does seem like there's always some way, at the very least, to defer it until, way beyond your death. So, I mean, I think that's kind of what you're alluding to
Right.
here,
I
right?
mean, what is it? The government shutdown, they always find some way to limp it along for another 3 to 6 months, right? Same thing.
Yeah.
They're all thinking about their own paychecks at home and taxes. They're always
Oh,
coming
yeah.
up with some kind of deferment way to defer the taxes, if not
Yeah.
extinguish it.
Yeah. Right.
Like
So,
opportunity zones or something like that.
yeah. Right. Well, so in this case, I mean, back to what you're saying about say I took out 60,000. Because here's another criteria that you can find for real estate in this part of the world, and that is, you could get a house that um, would be about $60,000, and that would be at let's say a 30 to 40% discount. Okay, so you buy it for 60. You put 10 into it, it appraises 90, maybe close to 100, and then you cash out refi, so you get your money back. I don't guess it works where you put that money back into the 401k by the end of the year, then you avoid the taxes. That doesn't work like that, does it?
No, I mean, you can do the loan, right? That's another halfway step here too.
Mhm. Yeah, yeah,
Um, and maybe take out
yeah.
30 and do the loan for the other 50, and then do the Indiana Jones switcheroo thing, like you're saying.
Right.
But I would,
Yeah,
I would strongly advise just taking it out in chunks. I mean, I paid the taxes and the penalty, and the penalty's nothing. I mean, 10%, give me a break. You're going to recoup that in 6 to 18 months easily.
yeah. Okay, man. I mean, you're speaking my language, that's for sure, Lane.
I mean, do them. Don't listen to me. Do the math yourself. The numbers will tell you what to do.
Well, okay. So the last, you can go on Google and you can basically Google, I'm going to take out of my 401k, how long would it take me to recoup? Okay. And I have run those numbers before, and, you know, I, I would struggle to explain it really well. I'm going to give it a try. I'll kind of butcher it, so forgive me. But essentially, I think after I'm in the 30. I think it's the 32% tax bracket. Okay, so I'm going to pay quite a bit on taxes. Let's say I take it all. Okay, let's say I kind of ignore that part where you're saying just take the chunk, but I just take it all, and then I pay the penalty. Like I said, I would be down to $170,000.
Yeah. But so I don't look at that big chunk you're paying. That's a wash. You're paying that now, you're paying it later. It's a wash. Don't even think
Okay.
about it, right? You following me?
Okay. Right. Yeah.
The
And
only delta is the 10% penalty.
okay.
So
And see,
so
well,
you're
let's
okay.
just assume that I do uh, account for the loss of the taxes as well as the 10%. I mean, some of these calculators that I've used, if I base it on, I think it's even like a 10% return on rental property, which, you're right. It's much more than that if you count in inflation and mortgage payback. And, if you want to put in appreciation in there, even, um, I mean, it's only like a 3 to 5 year time frame to catch back up to where I would be if I just rode this out, the 401k. So, I mean, even if I'm talking about only a 3 to 5 year recovery period, being kind of a middle-aged man that I am, that's really not a long time.
Yeah, and I think the most
That
important
makes
thing is it's time too, right? Because right now, I mean, the classic trap people fall into is they use this as excuse not to do anything. Oh, I gotta wait till I just save my money,
yeah,
and they're forgoing all those 3 years of actually churning and churning. I mean, for all we know, Jason, you could be like the operator on the next deal we do, right? In two,
yeah,
3 years.
yeah,
I mean,
for
Chattanooga is
sure.
pretty good market, right? And that would never happen if you never took 30 grand out of your 401k, 10%
Well,
of it.
that there never truer words have been spoken, that's for sure. And as I've started this whole journey, I mean, that's really the thing. It's what are you willing to risk sometimes for the future gain? And what you're talking about really in the grand scheme of things is not a huge risk.
Well,
Now there is
I
one
don't
major
think it's
hurdle.
I don't think it's a risk. I think it's a risk keeping in the 401k. I mean, that's
Okay,
what I'm
right.
more concerned about.
Yeah, and that's a great way to look at it.
I'd be
That
sweating bullets if that were me.
okay. Well, one other major hurdle that we haven't really discussed that's not so much a financial deal. There is that clause in there where, in this case, if I were to make withdrawals out of this, I would have to have written spousal consent. So, what does she say about all that?
Yeah, so this is where we'll come into the you got to get your partner involved, and I can't help you
Yeah,
there, man.
right. It's like a Dr. Drew conversation or something like that, or
Yeah,
whoever that guy is these days. I don't know.
could just
Dr. Phil. Maybe it's Dr. Phil, right?
yeah. So that's another person to help you out.
Yeah.
But here's the thing, right? You've got Goldcrest, you got Daytona, you got proof of concept. You're not like these other guys who don't have any liquidity other than their 401k and haven't done it before. You've got proof of concept.
Yeah. Okay, man. Hey, I'm gonna keep looking at it. I mean, the last time we spoke over the phone, it's good to hear someone from this viewpoint because you definitely don't hear. I don't hear this kind of talk at all. It's always like, you're crazy to even touch it. That's generally the mindset that I'm surrounded by.
Yeah.
So,
But you know
I
what?
mean,
Try the loan. Just do that because that's essentially what you did with the HELOC, right? You didn't sell your primary residence. You just took the HELOC.
right. I started using the lazy money.
Right. And if you didn't have the 401k, that's where I would look next. I would sell the primary residence, cash that thing out, or the old
Mhm.
primary residence, cash that out.
Yeah. Yeah.
But this is glaring low-hanging fruit right here. This is where it is. And don't do the infinite banking thing. It's not for you quite yet.
Okay. Okay. Fair enough.
I mean, maybe
Because
if you want to try it out for a few grand, 4 or 5 grand a year,
yeah.
like that. But
Well, I'll tell you. So the whole life that I've been shopping around, you're right there. It's a 5-year time frame before what I put into it, or the value of it is exceeded by what I put into it because you're paying the upfront fees and those kinds of things. And really, the way that it works well is that you just kind of slam a bunch of money into it. Um, so it's kind of capital intensive as well, I guess.
but I'll tell you something that's a lot better. Buying something like Daytona or Goldcrest.
Yeah, right.
Right. Do the numbers, right? Just put it on a spreadsheet and see which one really grows in the next 5 years.
Yeah, yeah. Because the guy that I've been talking with on this whole life insurance, I mean, it's not really a high pressure thing. The one thing that's been difficult about it is it is a complicated product, like how it's built, and there's all these paid up edition riders that need to be put on it, and there's these mech limits, and I mean,
Yeah. I mean,
it,
it's super
it's been,
complicated for sure.
yeah, it really is. And because, one of the big reservations I have about it is it's the old adage of, don't invest in something that you don't understand, right? And it is difficult for me to really get a good grasp on that whole life insurance.
Right.
So I have reservations about it, and I see what you're saying, and I appreciate what you're saying because you're bringing a perspective to my finances that some of this stuff is in the back of my head where it's saying, hey, don't do that, but with you saying it out loud, it
Yeah.
helps it even more. So
I,
so
I
I
think
appreciate you saying it.
I think with the whole life insurance, like I get what you're saying, and I do that sometimes too when people bring me like some random oil drilling deal or whatever. Like I don't understand it, so I'm not going to do it. But I think the life insurance thing can be really, really complicated. But essentially, it's kind of simple. It's a contract with a bank, and there are ways they can customize it with lower on the death pay. Sorry, my dog is just being really annoying right now. Let me see. Sorry about that. So,
No,
they can design it with, you want low death payout, you want high liquidity because that you're trying to take the money in and out, and you want lower on the return, the interest. And that sounds counterintuitive, but they always take it from you in terms of fees. They always get it somehow, right? It's priced in. You pay for what you get. It's like a syndication deal when you're getting a higher pref, and people just invest off a higher pref. But the general partner is not an idiot. If they're giving you a higher pref on the get-go, they're either taking it in high fees or lower LP splits in the back end. They're the smartest people in there. They're going to get theirs one way or another.
yeah, right.
And to just kind of know the infinite banking from don't kind of overcomplicate it. It's a tool, and to kind of even out liquidity once you have a good amount of it coming in. That's kind of the purpose of it. It's not the end all be all.
Yeah. Yeah. So there's a big thing out there. For one, the whole life insurance, admittedly, is kind of a fad, I think. And you hear a lot of people say, well, that's what the super wealthy do. So why not emulate what they do? The problem is, definitely me, I am not the super wealthy. Like I'm just the regular middle class American. So if I go trying to copy the super wealthy too much, it could get me in trouble. So that's another kind of reservation I have about the whole life insurance.
Right. The super wealthy are already in like a 24 private placement deals, and they have like $10,000-$20,000 of passive coming in a month. They don't know what the heck to do with it, so then they stuff the overflow in this infinite banking.
Yeah,
And
they
I made
have
that.
to.
I got caught up in the fad too. Like I said, I put a whole bunch my first year, and the second year I was like, oh, I got myself too much, right? I should have done like a tenth of what I should have done. And the nice
Yeah,
thing about this stuff is you can layer on another one right on top of it, right? So you can kind of
yeah,
grow into it.
yeah, or just go get another one. See that's kind of another thing about it too is this started out with like, hey, I'll put 4,000 in this year, and I'll pay a $400 a month premium. Well, now it's ballooned to this like, well, do 20,000 this first year because you need to put in an extra 10,000 for paid up addition riders and other such things. And then it's 10,000 a year in premiums for the next 15 or 20 years, I forget. Um, and then, at some point it does get to a point where you paid in so much and you're earning high enough dividends that it's paying for it's, the dividends are paying for the premium. And the value is so high that you don't need to slam so much cash in there. You can just let the dividends pay for the premiums.
Oh, I
But
think you're listening to the Kool-Aid that they're telling you though.
that's,
And it's kind of true. That's kind of true, but like just figure out what the money would have grown to if you would have bought more of these single family homes.
yeah, I mean, I think that's what we're saying here is like, hey, you know, if I have $10,000 a year, I don't need to be putting it in something like a whole life insurance. I need
Yeah.
to be putting it in a
Yeah. I
rental.
mean, it's marketing tricks, right? I mean, syndicators use them too. They're like infinite
Yeah.
returns, and you're kind of like, oh, that sounds really good. And then after on the drive home, you're kind of like, wait a minute, it wasn't quite infinite return.
Yeah.
Yeah.
Yeah. Well, I mean, the charts that they're showing me, this one, it seems plain as day. You get to year 20 and it's it you know the dividends pay the premiums because really to maintain the policy, the premium that needs to be paid is about $2,500 a year. So,
Yeah.
but
But
if you
take that document because I know what you're talking about. There's this, they give you this big spreadsheet, it looks super cool, but just take their benefit of the doubt, take that number at the bottom of the page, what it's supposed to be, and then compare it to what you would get by just buying rentals.
yeah, and I've even really just tried to compare it to the 401k, and quite frankly, it's taken me 11 years to get to $287,000 on this 401k. To get to that amount of money in that whole life insurance is like 15 years to get to like a cash value amount. So
Yeah, exactly. And that's
I'm,
why it's
I'm
actually
not sure those are really adding up. You know what I mean?
the 401k and like the 529 thing are complete garbage. To save money for your kids' education, it really should be in one of these infinite banking deals because now you
Yeah.
can put the money in and you can take the money right out and invest it for them in the 10 to 20 years you have to save, and then you can go take the cash value out or invest it again for them with cash flow.
Yeah.
I mean, this is just how horrible the 401k and 529s are. I mean, they're just vehicles, but the stuff that you're limited to investing in.
Yeah. I mean, really, where the whole life insurance policy made more sense was, I wish it would have been a choice. Hey, you can have a whole life insurance policy or you can have a 401k when I started the job. That was never going to happen. But had that been the option, the whole life insurance policy would have made more sense in that case because I could get the cash. I'd have it up to 250, 280, whatever right now. I'd be able to borrow out of it. Even though there might be less value there, I would still be able to use it at less of a penalty.
Right.
But
That's
that,
not what
that had to
that's not what
happen.
life insurance people sell. They don't
Oh,
sell an end banking type design.
and that would have had to have happened 11 years ago. So I mean, it's really kind of a mute point at this stage in the game. So
Yeah. But you're on a plan here to just buy a rental every year, right? Regardless. I mean, you're able to save that much. I think if you kind of come up with a plan, it sounds like you got to talk with the boss there, and you might be able to bump that up to 2 properties a year. I mean, in the next few years, you're going to be up to almost double digits. And, I think once you get up to 6 to 10 rentals, that's when things really start to get exciting. I mean, it took me so long just to get up to like the 10.
yeah, I definitely. So my goals here, as far as the rentals go, last year it was to try to get 10 within 2 years. I think I'm starting to realize that that might be a little lofty. I would be extremely satisfied if I were to gain 3 this year.
Yeah.
And that,
I actually don't really like those goals because I always hear it from like these young 10x kids. I'm gonna get 100 units or whatever, and they don't have a jack. They don't even have a job. I think a
Yeah.
good goal is to like look at how much money you're able to save a year and how much liquidity or tappable liquidity you have, like the 401k, and come up with a good game plan of like how much can you transfer from that illiquid money to rentals.
Hmm.
I think that's it.
Yeah.
And I think for you, you could get a grade C year for you would be 1. A B would be 2. I think an A for you would be a 3. And just take it 1 year by 1 year. Like
Hmm.
that.
Yeah. Yeah. For sure. I kind of feel like, I mean, getting the 2 last year. So some there's 2 hurdles I have with acquiring rental properties right now. The biggest one is actually finding the deal that works. Um, I mean, that's the biggest one. Honestly, getting the cash. I mean, if I had to, I'm starting to get out there and network even locally enough to where if I needed to get private money, it's available. And if you are able to buy a deal right, it would be the kind of deal where you could cash out refi and then get the money back out and then kind of rinse and repeat, that sort of thing. So that's kind of the one option that's out there, and I think that might be one way to sort of kind of speed the process up
Yeah.
too.
And I get the sense you like doing this a lot better than I do, kind of going out, finding the deal and then, and working the rehab.
It's a sickness I have, yes.
Yeah. Yeah. Well, it's good. You got a hobby. So that's good.
Yeah,
So,
yeah. It's there is good and bad things with it. I mean, um, I think what you're alluding to is, I spend a lot of time working on it. I spend a lot of time working in the houses.
oh, so you're
Which
actually doing the work.
Yes, and I mean that's something that I'm quite capable of doing. I also am able to create the time, not create, but I have the time to do it. But there's also the whole thing where I'm spending that time doing that work. What if I use that time to get more deals, or just check out other investments that I may be sitting there doing $10, $15 an hour work when really I should be doing $100, $200 an hour work.
Yeah. I mean, well, you're hitting it right on the head. I mean, you're aware of it, so you'll get there.
Yeah,
Awareness is the
but
thing.
right now, unfortunately, this is the system that I've created. It's the system that works. And I'm even though there are things that I know, there's still lots to learn, and these experiences. I mean, just like the spreadsheet that we're looking at here, it's just all something to learn from. So I would like a lot of these numbers to start getting better. A lot of these differences in acquisition versus the appraisal of the properties. I want that spread to increase. I want the prices on the rentals to increase, which is more of a market thing. I definitely don't want to get into rentals that are at the top of the market. There's obviously those problems there. Um, but just looking at the spreadsheet, I mean, it's definitely something to learn from.
Right. Right. So I think you got some action items. You got to think about the 401k, and then you've got the goal of doing 1 to 3 deals a year. And then you're kind of aware that you need to kind of step out of the business and put your time more in high dollar an hour tasks.
Hmm.
Um, was there anything off the top of your head? I mean, you got a game plan moving forward?
Um, I'm looking at uh, so my criteria before has been the 1% rent to value. I'm going to start looking more at distressed properties, uh, and that are not such a high acquisition number. And then another big thing, because especially this Brock Road house, you know there's some possibilities there of a good cash out refi. So, if I stick to a lower acquisition cost with more distress, um, I can cash out. It's a property that you'd be more likely to cash out refi, and I think that's a good way to build up cash available to keep building the portfolio.
I think that's a perfect plan. If I put on my Dr. Phil hat on, you more risk you take on, the more chance of a burnout or dropping the ball here on a deal, which happens, and then now someone won't let you touch your 401k. Something to be
Yeah,
mindful of.
yeah. Well, something I've really kind of realized with the Brock Road and the Goldcrest House is, there definitely the Brock Road. There was, you know, it was turnkey, but there were improvements that I realized I could make to add value to it. Especially like on the appraisal end. And I'm also realizing too that if you're adding value to the house, that adds appraisal value, it also adds rental value to it as well. So, it's kind of the old two birds with one stone there.
Yeah. The single point of failure I'm alluding to is like, a contractor running off with your money or a bad appraisal coming back. That's kind of
Yeah,
that's the whammy.
yeah. So with the strategy I have going on, it's the appraisal value that is the risk. The contractor part I've eliminated because I am the contractor. So,
Oh, okay.
um, but also, uh,
You just
it,
engineered that one right out of the system there.
right. But it's keeping my rehab costs so low. Okay. And it's really a pretty big advantage at this point. So, that's kind of, it's like you say, I mean, that's part of the way I've engineered the system. And if it's going to be successful with what I'm doing, then, that's what I'm going to have to do.
Right.
And it works.
Well,
That's why I continue to do it.
maybe an option would be just to sell the dang properties. And so you don't have to worry about the operation, go into passive deals and just keep doing what you like to do. Just hold on to 1, 2 properties at a time and just keep churning
Yeah.
this, keep putting it into the incredible machine.
Yeah. Well, so there's, changing my criteria is one focus. Another thing I've really started focusing on lately is, I'm starting to focus more on my marketing. And by marketing, I'm doing mailers now. And, essentially, if someone calls me tomorrow, saying that they want me to buy their house, what I'll end up having to do most likely is wholesale the deal, and which is kind of a good way to build some cash. So,
Mm-hmm.
There are some other angles there, or let's just say I'm kind of building the pipeline,
Right.
the best I can.
Right. Here's when I say you need to stop doing that is if you're not on track to do 2 a year, you need to stop doing that stuff. Because you're the critical path at that point. You're slowing things down.
Yeah,
Because
but I
you have the financial um you have the financials to do 2 or 3, even 3 a year. That's why I said it at 2.
okay. I mean, you're saying even this year, based on the numbers we talked about before, there should be no issue with me getting
Yeah.
2 deals
I mean, I
of
would
this.
say, check in here in the late summertime. If you're not getting into your second deal, that's a sign
Okay, right.
that
Yeah,
you're screwing around in the business. Or I forgot the saying is, on working on your business, not in the business, or I think it's the
yeah,
other way around.
yeah, right, right. Like the business owns you, you don't own the business, that kind of thing. You're an operator, not an owner.
Right. Right.
Yeah. Um, yeah, honestly, Lane, I really would like to acquire another house by March. I got a lot of feelers. I actually looked at a house. Let's see, what's the day? Friday. I looked at one Wednesday, and I emailed the guy. When I left him in person, we were still kind of far apart on the numbers, but I told him the offer. I was like, I'm going to offer you $150,000 in this house. And he was asking like 168, which really, I think he probably could get it. It turned out it was much closer to retail than I realized when I got there. Like the pictures, you never know. It's like, hey, that looks pretty nice, but you get there in person, and it's not that way. Well, this one was more retail. So anyway, long story short, I said, hey, I realize you got a really good house here, but this is kind of my criteria. 150, I could make this happen. And he's like, well, it's not what I'm looking for. I was like, I understand, but I'm going to email you my offer. So just so you have it in writing, right? So actually he emailed me back just a couple of hours ago, and he's down to 159. So, I mean, it is possible, I could get this, at least this next one sooner rather than later. So, and, I do have this, mailing campaign going on right now. And, I said, talking about wholesaling some of them, but I mean, if the right one comes along, I very well could just buy it. And I keep the 401k strategy in the back of my mind.
Right. Well, I'll leave you with parting words for my entrepreneur mastermind, where the coach has told me on 2 occasions when I'm on the hot seat on a conference call, that I will continue to be spinning around with my head on fire unless I find other good people to work for me. And this is like a year ago. Long story short, I'm still in the same position. I still do everything myself, but so take the advice, don't do what I do.
Yeah, no, I completely agree.
Easier said than not.
Yes. I mean, I have a coach as well. And, one of my big things that I've been talking about with him lately is trying to narrow my focus. Okay. And sure as the world, it's always easier said than done.
All right. So cool. Yeah. Check in with me in maybe about 6 months. And I don't know if this will be live yet because I'm going down to like 2 podcasts a week, and I just have a huge backlog on this. So maybe that'll be your accountability, that there'll be a checkup at the end of this call once the screen flashes black and I'm coming back and tell the world what Jason's up to these days. But thanks for jumping on and sharing this up to the folks, and hope you guys got a lot of value out of it, and sign up for the Who You Deal Pipeline Club, and we'll see you guys next time.